Imagine a single move on a chessboard that could completely redraw the map for how we all spend, send, and manage our money online. Well, that's exactly what we're digging into today. A rumored mega deal that has sent absolute shockwaves through the world of finance, pitting two of its biggest titans against each other. So, could one single deal really reshape the future of fintech? The short answer is yes, absolutely. Because when a private juggernaut like Stripe even thinks about acquiring a public giant like PayPal, it's not just another business transaction. No, this is a potential earthquake for the entire industry. So let's get right into it. What do we actually know? Well, reports started swirling that the private payments powerhouse Stripe has shown some early interest in buying PayPal. Now, it's super important to note there's no formal offer on the table. We're in the very early exploratory phase. But, the market doesn't wait. The second the news hit, PayPal's stock shot up about 5 to 7%. And when you look at the bigger picture, it all kind of makes sense. PayPal, the old guard, has been struggling with slowing growth for a while now, while Stripe is the aggressive up-and-comer, always looking for its next big move. It's the classic corporate predator and prey story. Welcome to everything you need to know about finance. Here's our game plan for breaking down this corporate chess match. First, we're going to look at the players and the prize on the table. Then, we'll map out 4 possible strategic moves they could make. After that, we'll dive into the numbers game and see how traders are actually betting on this. And finally, we'll look at the end game, the risks, and what this all means for the future. And just a quick heads up, this is a deep dive for informational purposes. It is not financial advice. If you find this kind of content interesting, do us a favor and hit that subscribe button. It really helps us create more explainers just like this one. Okay, first up, let's meet the players at the center of this clash of titans. To really get what's going on, you have to understand that even though both companies are huge, they come from completely different corners of the fintech world. And this really lays it all out, doesn't it? On one side, you've got Stripe, the private, high-growth darling of Silicon Valley. It's totally engineering-driven, laser-focused on building the back-end plumbing for online businesses, and it's got a staggering private valuation of around $159 billion. Then you've got PayPal, a public company, an established name, but let's be honest, it's been stagnating. Their focus is on consumer wallets, and their public valuation has taken a real beating over the last couple of years. This huge difference in their paths is exactly why one is seen as the hunter, and the other, well, the hunted. So you might be asking, why would Stripe even think about a move this big? Well, the prize is just immense. If they bought PayPal, Stripe would suddenly control both sides of the coin, the merchant infrastructure they already own and the gigantic consumer networks of PayPal and Venmo. Imagine the cost savings alone from getting rid of redundant systems. But the real goal here, the ultimate prize? To create a global payment super platform so powerful it could go toe-to-toe with absolute behemoths like Apple Pay, Google Pay, and Block. Okay, so now that we get the players and the motivation, let's dive into the strategy. In a high-stakes game like this, there are a bunch of different ways this could play out. We've boiled it down to 4 main scenarios. As we see it, there are really 4 paths this can go down. Is it going to be an all-in, full acquisition, or maybe a more surgical, partial one? Could this all just be smoke and mirrors, ending in no deal at all? Or will we see PayPal start making some defensive moves to protect its king? Let's break down each one. All right, let's start with the boldest, most aggressive play on the entire board. Stripe just buys all of PayPal. Lock, stock, and barrel. This is the kind of move that would instantly create a global leader in payments, but wow, does it come with some enormous risks. Now, what's so fascinating here is the trade-off. The pro is huge. You become the undisputed king of the hill overnight. But the cons? They are just as massive. You can bet that antitrust regulators in both the US and Europe would be all over this deal. Then you've got a massive culture clash. I mean, can you imagine Stripe's fast-moving engineers trying to merge with PayPal's big corporate machine? And finally, the sheer technical nightmare of trying to merge these two gigantic payment systems, it's just staggering. And that brings us to a much more realistic and, frankly, a much more common scenario in the world of these mega deals, the partial acquisition. So instead of trying to swallow the entire company whole, Stripe could make a much more precise, almost surgical, strategic move. So the key question is, what would they buy? Stripe could go after PayPal's crown jewels, like Braintree, which is already a direct competitor, or the incredibly popular consumer app, Venmo. This approach is smart. It lets them grab the best assets without all the headaches of a full merger. It dramatically lowers the regulatory risk, it simplifies the integration, and it would actually leave behind a leaner, more focused PayPal. But what if no deal happens at all? In the world of M&A, rumors often serve a purpose, even if they never lead to a handshake. And this is where the game theory gets really interesting. So let's look at how these two possibilities play out. Even if it's all just talk, the rumor itself forces change. Suddenly, PayPal's management is under a microscope, with investors demanding better performance. But if PayPal thinks a hostile bid is a real threat, they can start playing defense. We're talking moves like stock buybacks to keep shareholders happy, maybe spinning off a valuable piece like Venmo, or even finding a friendly company to merge with, the classic white knight defense strategy. Okay, let's switch gears and look at this from a completely different angle. The money. Whenever rumors like this start flying around, a special type of investor, called an arbitrage trader, jumps into the fray to try and make a profit. Let's break down exactly how they think about it. The key idea here is called merger arbitrage. It sounds complicated, but the concept is pretty simple. After a deal is announced, the company being bought usually trades for a little less than the final offer price. Traders buy that stock, betting the deal will go through, and they get to pocket that little difference or spread. Let's use some real numbers to make this clear. Right when the rumor broke, PayPal stock was hovering around $45 a share. We'll call that our starting point.
Now, let's just imagine Stripe comes in with a real formal offer. A price tag of, say, $60 a share would be a pretty reasonable premium to get a deal like this done. That gap between $45 and $60, that's a potential profit of about 33%. Now, for traders, if that deal closes in, let's say, 9 months, the annualized return is just massive. We're talking well over 40%. You can see why this kind of thing gets them so excited.
But here's the thing, the pros don't just look at the potential upside. They calculate something called expected value. This table breaks it down perfectly. They assign probabilities to both success and failure. So let's assume if the deal fails, the stock tanks to $35. If there's an 80% chance of success at a $60 offer, the weighted average, the expected value, is $55. At $45, that's a clear buy. But if the chance of success drops to just 40%, suddenly the expected value is only $45 and the trade makes no sense. It is all about weighing that risk versus the reward. So as we get to the end game of our analysis, it's time to zoom out. Because beyond all the numbers and the strategies, there are huge, hidden risks that could sink this whole thing and change the future of finance along with it. Think of it like an iceberg. Above the water, you have the obvious risks, right? Regulators in the US and EU could just say no way and block the deal. But beneath the surface, you have financing risk. How does a private company like Stripe even raise tens of billions of dollars? Then there's execution risk. Smashing two giants together is incredibly hard and could end up destroying value instead of creating it. And finally, there's this idea of a value trap. Even if nothing happens, PayPal is trading at a historically cheap valuation. It might just be a bargain all by itself, deal or no deal. And this really brings us to the biggest question of all. This rumor isn't just about Stripe and PayPal. It's a signal. Is the entire fintech industry, which was born from thousands of scrappy startups, now entering a new era? An era of consolidation, where only a few mega platforms will be left standing? At the end of the day, this rumor has put every single player in the payments world on high alert. Whether PayPal's future involves Stripe, or a defensive merger, or a tough solo turnaround, one thing is for sure. Its stock has been beaten down so much that it is now officially in play. The next move in his high-stakes chess match for the future of finance could come from anyone, and it will send ripples across the entire financial landscape for years. If you enjoyed this deep dive, be sure to try out our latest episodes.